for somebody who's an existing home buyer who has a good equity position in the property is called a blanket loan mortgage. Okay? So a blanket loan mortgage, think of it like this. You've got house one over here that you already own. You've been in it maybe for a while. It's appreciated in value. The loan balance has decreased over time. And so you've got a good equity position in that property. Okay, so for this example, let's say that $100,000 is owed on that property, and we'll say that it's worth $200,000, just for simple math. Now, the house that you want to buy is a move-up property, so we'll say that house is worth, $300,000, and you don't necessarily have a lot of liquid cash. You have $100,000 tied up in equity in house number one. So with having that current mortgage and then the thought of taking on a second mortgage, with a conventional fixed rate loan could be really difficult for a lot of people, just from an income standpoint, going back to that debt to income ratio. So the blanket loan kind of fixes a lot of that. It basically says like, hey, if you've got house number one with a lot of equity, you could buy house number two potentially with no money down. And the way that would work, Ted, is we would take the current loan balance that's owed on house number one of $100,000, and then we would roll that into the purchase price of the house that you would be buying on house number two. So that would give you a $400,000 mortgage loan, and we would have that mortgage blanketed over two properties. So hence the name blanket mortgage.